Thanks for joining in, everyone. This is going to be our last webinar for the year. Just a quick audio check and then we can get started. Let me know if there's any issues. Okay, audio seems to be good on my side. Okay, good. Audio is great. So thanks for joining in. This is going to be the last trading day for 2022. This is going to be my last webinar for 2022. And we'll take a break for a week and then we'll jump back in second week of January. All right. So let's wrap up what we have covered for the past 3 months, right? So we have come to the stage where we are going to start building your own trading strategies. So I'm going to go through some of the key pointers on what you need for your trading strategies. But just before we begin, very happy New Year to everyone. Hopefully you guys are enjoying the upcoming holiday. And hopefully you guys are staying healthy and having a great time. Okay, my name is Vito and let's get this started. Just quick general advice and risk warning disclaimer. Note that any advice given is deemed to be of general advice, as the information or advice given does not take into account your particular objectives, financial situations, or needs. Therefore, at all times, you should consider the appropriateness of the advice before you act further. We do not offer signal service, managed funds, or other personalized advisory services. Please be aware of scams that promises guaranteed returns or managed accounts. CFDs and Forex are leveraged products that carry a high level of risk and are not suitable for everyone. You can lose more than your initial deposit, so you should ensure CFD and Forex trading meets your investment objectives. Strategies and charts used in this presentation are for example only. You are reminded that past performance is not indicative of future performance. Again, any questions that you guys have to type it in. If you want to stop me halfway through and if you have any questions, just type it in. I'm good. How are you guys? I'm great, Machindra. Screen is not clear. Screen coming through okay with everything for everyone? Okay. Let me know if there's any issues. Screen on my side looks okay. Could be the connections on your side. Audio seems to be good, so we're not having issues like last Wednesday. Okay, so we are going to cover a few things just to keep it short. It's basically just going to be 4 pointers. Number one is, why do traders need a trading plan? What is the composition of a good trading plan? And you need to have trading plan that's adjusted to market conditions. And then we'll talk more about individual risk. We'll talk more about individual risk profile and experience as well, because that's going to factor in into how you're going to build your own trading strategy. Okay. Go through this, and if you have any questions, we can come back on the second week of January. And then if you want to help, you need help with building a trading strategy, then go ahead. I like to use the word trading plan rather than trading strategy, but that's what we need to look at. So why a trading plan? So I think a trading plan, it's a must for all traders, and I think this is going to suit the end of the year as well, where we reflect on how we were trading for 2022, right? So to me, a trading plan, it's the path to consistency, and for you to be a successful trader, it's not, having a great, oh, of course, having a great trading strategy, it's great, right? I mean, you don't actually need a 100% probability on your trading strategy, because I don't think there's going to be a trading strategy that has 100% profitability or consistency in it, right? I think we are looking at anything greater than 40-50% is actually a great strategy or a plan, as long as you manage it well. Okay, so to me, a trading plan, it's basically your navigation map of the market. We need that to figure out where we are in the market and how we are going to proceed going forward in the market, right? So having a trading plan is basically to take care of ourselves from an emotional standpoint. We covered a lot of this on the trading psychology aspect of the webinars, right? And with a trading plan, the purpose is to make all decisions to become objective and not subjective. And that's basically the goal of your trading plan. Of course, this is going to be different from one trader to another. How do you define something that's objective and not subjective? There's bound to be a certain degree of subjectivity in your trading plan. But look, anything that suits you and you're comfortable with, I think that's a great start. Okay, so another thing that we haven't talked much about, which we will actually talk more as we go on into the more advanced webinars, is that a trading plan, it's actually needed. It's a necessary component to actually improve yourself as a trader, right? That's basically what traders do, and that's basically what we do in everything we do in our life, right? We want to improve ourselves. We don't want to just stay still, especially with a market that's dynamic. Okay. Um, we want to keep on our toes at all times. We need to be aware of things that's going on, and we discussed this. I discussed this, pretty much throughout the whole 2 weeks in several webinars, that I do actually find 2022 a challenging year compared to 2021. I think we had an easier time in 2021. I think there's a lot more surprises in 2022, and that's where the part of improving yourself as a trader comes in, because we don't have a trading plan, or if you only have a single trading plan, then we are in a lot of trouble in 2022 because the market shifted a lot, right? So, trading plan basically instills a good habits and avoid your bad habits that are often done by traders. For example, letting your emotion comes in. You saw a market that rallies up, and you kind of try to catch on to that trade, and then what you find is that you caught the trade at the very end, and then the market reverses. Well, it corrects itself, and then you got stopped out and stuff like that. Okay, so with the trading plan, the risk of a trade can actually be measured and controlled, and I think that's the major reason why we want to have a trading plan or a trading strategy. I don't like the word trading strategy because I think it has a different meaning. Okay, it's good to use like trading strategy, and everyone's just talking about trading strategy. Everyone wants to have a high probability trading strategy, a quick profit trading strategy. I don't think trading is about strategy. That's really more, well, a strategy and a plan, it's a very similar word, right? But I like to use the word trading plans because I need to make my plans in terms of where my risk is going to be, where should I exit the market, and so forth. If we trade based on price action, like price bounce or rejected, does that count as a trading plan? Yeah, it does, right? So this will encompass everything. Your trading plan could be based on an indicator. It could be based on looking at divergences. It could be based on measuring the momentum. It could be based on price breakouts. As long as you know what kind of plan you have, I mean, when we talk about plans, it's not really what triggers it, like what triggers the trade. It's more about how you actually want to manage that trade, right? Do you know your risk before you get in? If you're in the trade and you're profitable, do you know where to get out? I think that's more in line, and the reason on why I call it a trading plan, because I think trading strategy, if we talk about trading strategy, people only think about the profits, but to me, I don't know. This is going to be different from every trader, right? Um, but I do have a few issues that I'm facing myself. Obviously, I have an OCD problem. I'm also an ADD. Um, I suffered from ADD, so I think I get anxious a lot more than any other people, right? But look, I want to know what my risks are first, and I want to have everything laid out. I want to have everything planned out. So that's probably why I love my job so much. That's probably why I trade. Um, I ended up trading as a career. Okay, okay. So that's why we need a trading plan. So we already looked at the why. Okay, so let's just jump into a composition of a trading plan. It must have the capability to determine the price position relative to the market, i.e., you need to know it's like opening up Google Maps and then looking at your current location where you are before you can actually be sent, before you can actually ask for directions, right? Before you can actually use a navigator to help you get somewhere. This is it. You need to know where's your current location in in, in relation to the market, right? Do you need you need to know whether the market is in an uptrend, it's in a downtrend, or is it going sideways. So we need all this. Okay, all right, that's number one. So it has to have the capability to determine where you are in the market, and if you can identify if the market is in an uptrend, a downtrend, or sideways, that's going to be great. Number two, it must have the capability to measure momentum in the market to a certain degree, right? It doesn't have to be perfect, but at least you need to know if there's going to be a driving force behind a certain breakout. You need to know if uh, a trend transition is going to have enough strength to carry on and continue to create a new trend. So to a certain degree, it has to have that capability to measure momentum in the market. Doesn't have to be perfect on it, right? But you need to have something. All right. Can we use price action to determine if there's momentum in the market? Yes. Just to put it simply, if there's a breakout, then you do know that there's actually momentum driving it. If you understand how to take advantage of people lining up their stop losses at a certain price level, I think that will be your momentum indicator for that trading strategy. Okay. Number three, you need to have the capability to read the sentiment in the market. This one here, it's going to be a little bit tough to isolate, right? Because when we look at sentiments, that's going to be ever changing. Sentiments is also going to be different if you're looking at different time frames. Okay, so but you'll figure it out over time. I think this is really more experience rather than anything else. But we can use indices. We can use the index to measure, what the equity is doing. If the market is bearish, if the equity market is bearish, is there going to be a spillover? If a certain asset it's in a certain trend, is there any reason behind that? For example, we've been talking about China for the past month or so, right? I think the sentiment right now is that, yeah, people want China to open their borders. People want to have tourists from China because they are actually one of the in terms of tourism industry, I think a lot of countries actually needed a return from tourist China tourism, right? And the concern right now is that if they open up the borders, that could boost up the tourism industry, but at the same time, it opens up a potential risk of another COVID wave. Okay, that could be that, right? We will read that as a potential change in sentiment. So people are currently, hoping for one thing to happen. How's that going to play out, right? And then we read up the sentiment in the market. If the FOMC hikes interest rate very, very quickly, is that going to crash the market? Is it going to create such a slowdown in the economic growth that it would actually crashes the economy? That would be how we look at sentiments. Again, sentiments are going to be very specific in terms of what time frame you're looking at when you trade. Okay, all right. And the next one, it has to have the capabilities. Sorry, it must be able to provide entry and exit signals. Obviously, we call that a trading strategy, but a lot of people are more focused on where's the entry, where's the exits, right? There's a lot more to a trading plan. There's a lot more to a trading strategy. So it needs to be able to provide entry and exit signals, right? In a very specific set of rules. Okay, if this ABC happens, that would be my entry. If DEF happens, that would be my exit. That kind of stuff. So you need to have this outlet. How do you measure sentiment in cryptocurrencies? It's this is going to be very wide in terms of the range of the market, right? Because we got altcoins, we got a lot of coins out there, but we'll look at stable coins to really figure out what the sentiment is in the market. So you can use Bitcoin, even if you don't trade Bitcoin, as more of an indication to read out the sentiment in the market. Because if, you know, Bitcoin moves up, then if it's bullish, then it might actually carries more of a bullish sentiment toward the crypto market. What is the reason behind that? That's obviously something you need to figure out. But the first reaction when you look at the market, you know, oh, I just opened up my chart this morning, for example, and then you look at a sudden rally in Bitcoin, then you would check on other coins if they actually carry the same sentiment. So you could use that, for example. I would really use indices. That's why we look at the dollar index. Number one, if every weekly outlook that I put out there, I always take a look at the dollar index every week because I need to know what is the sentiment in the market. Is it going to be positive or is it going to be negative for the US dollar, for example? Why is Nasdaq 100 different than gold? For one very simple good reason. One is an equity market, the other one is a commodity market. One's a benchmark on stock markets, right? And the other one, it's just commodities. There's different driving factors. So we could look at different markets and we might have different readings on a lot of stuff, right? For example, Mohammed just asked cryptocurrencies, and a lot of people are confused with cryptocurrencies, especially new traders, is that a lot of new traders that don't really understand the mechanics of the market thought, there's the word currency in there. So it's actually the same as the currency market. It's a completely different market. I would actually classify it as a completely different asset class. Okay. So obviously the Nasdaq, that tracks the equity market. It's going to be different in terms of how price move, how you observe it, what kind of strategy you use for Nasdaq and for gold is obviously going to be different. Okay, so let me put this into perspective. If you're not trading CFDs, you're actually not able to trade the equity index. So Nasdaq, S&P 500, US 30, you're actually not able to trade that. So people that have no capability of trading those indices actually still look at those indices, right? Because it's just going to give them a shortcut. If it rallies up when the US market opens, then they could plan in terms of opening up individual shares, whether they should be buying or whether they should be selling their shares. So I think it's more of a benchmark than anything else. Okay, the last one, you need to have an appropriate risk management, obviously. All right, and this is probably the factors that a lot of people kind of ignore, right? Because when we talk about risk management, we talk about your psychology, we talk about your money management as well in terms of growing your equity. How do you do that? And yeah, that sort of stuff needs to be part of your trading plan. So when we talk about trading strategies, I think a lot of people are just looking for entry and exit signals, but we take a look at the word trading plan, then it's much more than just an entry or an exit into the market. Okay. All right, so that's the composition of a trading plan. Any questions so far? So, and is there any issues with picture quality? Because I'm checking it on my side and it looks perfectly well. Okay, but do let me know. Team Octa, do we have any issues with the video, or is it's okay for me to continue? Okay, I'll just continue until we get an answer. All right, next thing, it's going to be trend detection, right? This is going to be one of your main components as well when it comes to trading plan. You will need to have a certain ability to detect changes in trends, right? You need to be able to detect changes in the underlying trend. No issues with video? Okay, good. Yeah, Emmanuel, I do apologize for what happened 2 days ago. It was so bad. I re-watched it, and I'll be honest with you, I'm super embarrassed. Okay, okay. Trend detection basically should be able to provide you with an indication of market conditions. So you would need to be able to figure out whether a market is trending. It could be an uptrend or a downtrend. And then if you if it would actually tell you if the market is consolidating. Okay, so I use the word trending and consolidating. Trending, uptrend or downtrend, just those two. Consolidating, it could be a sideways, a range bound market condition within a correction, right? Consolidating. So the moving average is probably the easiest indicator to use as a trend detection. Global markets would actually, in general, non-specific, non-trader specific. Um, if you look at any reports out there, for example, from CNBC or from Bloomberg, they'll pull out a chart and then have the simple moving average on 50, 100, and 200, because a lot of people from the olden days basically use those as a potential indication to measure a trend, right? So if the market is above 50, then there's a probability it could go and attempt to move above 100, and if it above 100, the next one is going to be 200. If it's above 50, 100, and 200 prices above those levels, then that's going to be a strong trend. This is just an example. You can use anything you want, right? So the use of the moving average as a trend indicator can actually be formed as a crossover or a price position above or below the moving average. I think we discussed this kind of strategy in the previous webinar as well, and when we introduced technical analysis, I think we did mention a little bit on using these moving averages. Okay. Um, if you guys want a shortcut on this one, using moving average with a small differentials in parameters can actually be used as a trend detection. So let me just give you something, right? If you use 80, 1, and 100, that's going to be a lot less crossing that's going to happen in the moving average. If you use 8 and 10, that's going to be about the same thing. So in terms of being very, very specific on this one, I don't have anything very, very specific. I would actually use anything that I'm, as long as you're comfortable with. If you're not comfortable with using a higher period moving average, then don't use something smaller. For example, you can use 15 and 20. That would kind of give you the same impact as well. Okay. Other indicators that can actually be used, I use this one. I use Ichimoku Kinko here, right? That's basically how I use what I use for my trend detection in the market. You can look at alternative Japanese charting such as Renko and Kagi. Um, if you guys are used to with Bollinger Bands and you know how to use Bollinger Bands correctly, then by all means feel free to use Bollinger Bands. Um, I just think Bollinger Bands it's really one of the most abused indicator by a lot of salespeople out there, because Bollinger Bands in retrospective, it's going to look perfect. Like you see every turn in the market, you see the trend correctly and stuff like that. But when you use it live, you don't actually have that kind of accuracy because it's dynamic. It's shifted a lot. Okay. Right. So to answer the question from David, what's the best strategy for Forex? There's no such thing as the best strategy. So look, everyone looking at the same thing. You guys are looking at pound USD, for example. We all might have, maybe a thousand different trading strategies there. So yeah, there's no best one out there. I'll be honest with the answer. And we're trying to cover that today. The best trading strategy to me is that something that that's really suitable for you, that you can actually develop your own and you have confidence in it. I think that's going to be the best trading strategy. All right, number two, in terms of momentum, so we're going into details, right? Number one, we need to have that trend detection. Number two, we need to have that momentum indicator, right? So momentum measurement is actually really, really important because we need to know if that's actually going to be a driving force behind a certain movement in the market, right? Indicators in the form of oscillators are indicators designed to read momentum in the market. So there's a lot of options out there. Obviously, we have a lot of oscillators out there, but here are the main ones. We got the MACD, that's the moving average convergence divergence, and then we have the RSI or relative strength index, and then we have the CCI, commodities channels index. So if you're a commodity trader, really old school, and you're trading soft commodities, then I think you're going to be very familiar with CCI. Currency traders probably wouldn't be that familiar with CCI. Stochastics, you see this every week, every session that I have every week. Stochastics, you see that. Williams percent range, I think, Williams percent range. This is actually something really, really new. Um, but yeah, you could use that. You could use the ATR, which is the average true range, which is good to measure a certain range in the market, good to measure a certain momentum in the market as well. What's RSI and MACD? RSI is relative strength index, and the MACD is moving average convergence divergence. Okay. We covered this on a separate webinar. If you want to understand more about this, you could look at understanding volatility and momentum in the market. This is actually the first one that we did in this marathon series. I think it was about 3 months ago, but just go to OctaFX channel on the YouTube channel and just search for understanding momentum and volatility in the market. So I do cover MACD, RSI, and stuff. The other webinars that you might want to cover would be looking at divergences. We covered MACD, RSI, what's the difference between all of them. Okay. All right, so changes in momentum can indicate the strength of a certain move in the market as well. So if we have a breakout and momentum is just coming off we have a breakout to the upside and the momentum is just coming off the oversold condition, then we have a lot more reason to jump in on that trade. We saw a bullish divergence. We anticipate a potential reversal in the market. If we saw a hidden bullish divergence, then we expect more of a continuation in the market. So that's one of the main reasons we look at divergences in the market. We really want to measure if there's actually going to be any strength in a certain breakout or a certain rally in the market. Or if a drop in the market happens and you want to short the market, you want to sell in the market, you really want to know if there's actually any reason why the market is falling very, very quickly. All right, so we need to measure that from a technical perspective. We measure momentum and volatility in the market. That's from a technical perspective. Um, from an emotional perspective or from a fundamental perspective, then we look at sentiments. So I think momentum and sentiments are, two sides of a coin. It does the same thing from a different angle, right? Okay, so changes in momentum can indicate the strength of a move or change the direction of a movement in the market. Momentum changes does not reflect price changes and vice versa. So that's why you need to watch that understanding momentum and volatility, because we talk more about velocity in the market rather than, price movement being equal to momentum in the market. Okay, so that's momentum. The next part that we need to have would be the market sentiment. Again, as I say, this is more on experience rather than anything else, because it's not going to be easy. I don't. It's not going to be easy because there's a lot of different ways to look at sentiment or identify sentiments in the market. But there are going to be several ways to read sentiment. If you trade equity, then volume indicators is going to be great. Okay, and that's probably why I can give you out a warning that in December we're going to anticipate more of a lower volume in the market. We don't expect a lot of movement in the market for the past 2 weeks. We can use volume indicators as an indication. I don't think volume indicators are going to be great for the currency market because I think every broker, every liquidity provider is going to have a different volume from one another. But at the very least, it's going to give out about 40% of the sentiment in the market. Okay, if there's actually going to be enough market participants in the market to move a certain market. Okay, we could look at candlestick patterns, right? You guys, we covered this during introduction to candlesticks, right? So candlestick patterns, it's going to help out. We could use chart patterns, right? Like gold, for example. We talked about gold this week, and I was looking at potential rising wedges. That's one of the chart patterns. We're looking at the sentiment in the market probably going to be shifting a little bit because there's a lot of other indicators out there indicating that the current price movement in gold might not be the true direction in the market. Okay, so we can look at chart patterns. We could use simple support and resistance trend lines. Very, very simple. Obviously, if we have a support trend line, we know that there's a certain bullish sentiment in the market because we have a support trend line that goes up to support the market. If we have a resistance trend line, then we can say, there's a little bit of a bearish sentiment in the market because market gets capped and then progressively creates a lower high. We could also look at psychological support and resistances. We covered trend lines, all of this, I think, in the second webinar when we talk about introducing technical analysis. Okay, we could use pivot points. This is something that I pointed out in a lot of my outlooks every week. Just kind of a barrier in terms of whether or not there's a bullish or bear sentiment in the market. If price opens up the week above the pivot points, then we measure that as a certain bullish sentiment in the market. If it opens up the week below the pivot level, then we expect more sellers to come in and pressure price lower. We could use that. We could use Chico span. All right, that's part of a Ichimoku Kinko Hyo to measure sentiment in the market. We could refer back to divergence, right? So divergence, it's I really like, and I do put a lot of emphasis on divergence because at the same time you're measuring momentum and volatility in the market, you are actually reading the market sentiment as well. So I think that's probably why I use a lot of divergences in my trading. I try to identify them as much as I can. Triangulation, we could use that. This was brought up on the webinar last night, and there was a question: why was the euro stronger than the pound? It was pretty clear if you're looking at the difference between the euro USD and the pound USD through the euro pound, which is basically triangulation in the market. You would be able to identify that the euro was actually stronger than the pound, and one of the few reasons behind that is that on top of the ECB hiking interest rate this year, they are at the same time doing a quantitative tightening where they actually reduce their assets, right? And in 2022, without people realizing it, because everyone's just focused on ECB hiking rates, they've actually reduced their asset holdings by about close to 50%. Okay. So that's going to give a much more bullish sentiment on the euro, something that supports the euro than the pound. Okay. So the essence of reading sentiment is to look for indications of a trend continuation or a potential reversal in the market. And that's basically what we look at. That's why we use candlestick patterns. That's why we use divergences, because we're looking at a potential continuation or changes in a certain trend. Okay. Sentiment can also be used to anticipate an increase or decrease in momentum. We can use that, and basically that's something that I've applied for the past 2 weeks. Sending out warnings. Hey, volume is low. Momentum might get a little bit choppy because we don't have a lot of market participants in the market. People are away for their holidays. Like today, I don't think a lot of people. Probably about 30% of the normal trading days in terms of the volume of traders. Probably only 30% of them trades the market today because this is the last day of trading for 2022. Okay. All right. What makes this category difficult is the use of sentiment indicators which have different functions, right? We could look at pivot points, divergence, triangulation, candlestick patterns, chart patterns. They all have a very specific use case scenario, and this is where it gets confusing for a lot of people, right? How do I measure the sentiment? I'm just throwing out a few examples here. Maybe pick one to start with if you don't have if you don't have something to measure market sentiments. Maybe pick one out of the bullet list that we have here, and then maybe use that to start using them as your sentiment indicator. Okay. All right. Next one, it's going to be entry and exit. This is where a lot of people are going to be focusing about 60%, 50% of their trading plan, figuring this out like crazy, right? So this is where the part trading strategy comes in, because to me, a trading strategy would require trigger points, and when we associate strategy, it's more associative with entries and exits into the market. So it simply is just something that can be used as a benchmark or a comparison for opening and closing trades systematically. And the word here is systematically because you want to be more objective than subjective, right? So some strategies that can be used, and we covered, I think we covered all of this throughout the marathon series the past 3 months, right? So you could use Fibonacci retracement and extensions. You can look back into Fibonacci webinars that I did. I think this is going to be about halfway through, about 1.5 months ago. We could use moving average crossovers by using long and short moving averages, right? This is an example. We can use the Ichimoku Kinko here, which we covered over the span of 2 separate webinars. You can also use candlestick patterns if you want to. Range breakouts, UK and US open strategy. Yeah, I don't think I covered this specifically for the marathon series, but I think we are going to cover this more in the future. Previous low or high breakouts, market creating a higher high, maintaining an uptrend, market creating a lower low, maintaining a downtrend, that kind of scenario, that's where breaking the previous high or previous low comes into play. So this is more on price action. And if we've got chart pattern breakouts, triangle breakouts, flags breakouts, pennants, wedges, all those chart pattern breakouts, you can use them. Okay, if you take a look at these strategies here, this is actually split up into a few things, right? Fibonacci retracement extensions would fall into price action trading. Moving average crossovers would fall more on indicator based trading. Ichimoku Kinko here, it's actually both of them, both price and indicator based. Candlestick patterns is actually price based. Range breakouts is price based. Previous low or high breakouts is actually price action trading. Chart pattern breakouts are all price action trading. Okay, so I'm just throwing it out there, that you actually have a few choices. Do you want to look at an entry through an indicator, for example, the moving average crossing over, or do you want it more on price action trading, right? We want to see if the price actually maintains a breakout and stuff like that. So calculating entry and exit is the main component in a trading strategy or trading plan. It's basically used to maintain capital, find out if we are in the wrong direction, and gauge limits so as not to over trade. Okay, so this would be your entry and exit, because if we know our risks, we would be able to measure how much equity we have. I think there was a question there, what kind of strategy should I use for a $50 account? Hey, I'll be honest with you, $50 accounts, can you start out with that $50 account? Yeah, I think you can experiment with $50 account. The best strategy for that kind of account size is actually to realize what kind of equity you have and what kind of lot sizes you should be opening, right? You don't trade a mini lot size with a $50 account, because I don't think that's really possible. Even with a micro lot size, it's really pushing it. But if you can adjust it accordingly, then I don't think that's going to be that much of an issue. But just to throw it out there, it's not really about the best entry or exit, but more realizing in terms of money management and whether or not you can actually grow the equity. Is it good to use more than 2 trading strategy on my trading plan? Yes, which we will cover a little bit later on. But you actually need to have 2 trading strategy at all times, right? You cannot trade with just one trading strategy, and I'll give you a reason later on. But hang on. But that's a very good question from Mohammed. That yes, you would actually require. It is actually required that you have two different trading strategies. What do you think is best, market structure or price action? I don't use the word market structure. I think that's just a coined term on something that people just want to look sophisticated on that. But understanding what the market is, it's basically looking at price, right? And identifying price action. It's basically the same thing. I seriously do not use the word market structure. I don't know where this word comes on from, but I think in the past 2 years, I keep getting questions from traders, or maybe I'm just too old-fashioned. I don't know, but I don't use the word market structure. But figure out where we are in terms of what the market is doing. I think that's really more price action rather than indicator based. $50 account, what's the best leverage to use? With $50 accounts, the higher the leverage, I think that would be required because you don't have a lot of room movement in terms of equity with a low leverage with that kind of account. Okay. All right. Next part is risk management. All right. Trading plan, as I always say, must take into account the risks in the market. Risk management is going to be different from each individual, which makes each trading strategy unique, right? We could be using the same strategy, we could be using the same moving average, we could be looking at the same Ichimoku Kohyo, we could be referring to the same Fibonacci retracement and extension, but we have different risk management in the market. We will trade, or we actually will have a different trading strategy because my exit levels, more my stop losses, my target levels are going to be different depending on your risk. So again, this depends on the risk tolerance of each individual. Some have a very high risk tolerance in the market and they're willing to jump into a 1.5 risk reward ratio, for example, or maybe you're comfortable with doing a 1-to-1 risk reward ratio, risking 50 pips for 50 pips gain. But I'm more on the 1-to-2 risk reward ratio, guys. So if I look at my risk, that I might have 50 pips as a potential risk in the market, then I need to have a plan laid out that shows me a potential target of at least 100 pips, right? I'm more of a 1-to-2 risk reward ratio, guys. Okay. So capital risk that can be adjusted. Capital risk is obviously the question that we have here with $50 accounts. What kind of risk do you want to have? Do you want to risk $10? Do you want to risk $5 for your trading account, or what? That's going to be adjusted from your capital risk. Trade risk, that's going to depend on the overall trading plan. For example, I just talked about what the potential 50 pips risk in the market for 100 potential gain, right? That's going to be the trade risk. It's going to be separate from capital risk. We talk about this on risk management as well. Okay, so trade risk will depend on the overall trading plan, which prioritizes the calculation of exit levels, be it stop loss or take profit levels. So I keep mentioning risk reward ratio here. I want at least 1-to-2 risk reward ratio before I open up any trades, right? That's part of my trading plan. Stop adjustment rules such as trading stops must be included in the trading plan to maintain floating profits. When we talk about trading stops, this is where it gets a little bit confusing because I think a lot of new traders that jump into and we talk about trading stops is that if the market moves a certain period, a certain range, and then the stop loss get adjusted automatically. That's one way of looking at trading stop loss, but I don't really refer that in my trading strategy. I use trading stop losses, but I look at swing highs and lows instead of market moving a certain pip, for example, and then you automatically start adjusting your stop losses. I don't, my trading plan doesn't work out well with automatic adjustments, so I do adjust it manually. Okay, so trading strategy to suit different market conditions, and this is going back to the question that was brought up by Mohammed. If I have two trading plans, would it be better? Actually, yeah, every trader, as I say, must have at least two trading strategies because we can categorize the market into two. It's going to be trending or it's consolidating, right? So whether it's in an uptrend or a downtrend, you use one strategy. If a market is sideways consolidating or ranging, you would actually be required to change up your strategy to suit that market condition. Okay, because trading plans made specifically for trending markets will fail when the market becomes sideways and vice versa. So if you have a trading plan based on Fibonacci retracement and extension, for example, that's more for a trending market. If you have a price breakout, if we anticipate a higher high, higher lows, that's going to be suitable for a trending market. It's not going to work when the market all of a sudden goes into a range bound market condition. So you have a few choices, right? If you haven't come up with two trading plans, just identify what kind of trading plans it is. What kind of market does it work for? Does it work for a trending market or does it work for a ranging market? A lot of my strategy is actually more on trending markets, right? I do have a couple of strategies for range bound market condition, but from experience, I just choose to stay away from a range bound market condition because a lot of my strategies doesn't work very well in a sideways market condition. So, for example, in the Euro USD, the past month, the past 2 weeks, I've actually stayed out of the market itself. So that's part of my strategy, right? So changes in market conditions can be read from trend indicators, which must be a consistent part of a trading plan, which is the first requirement of a trading plan. For example, trading plan that was shared in the previous webinar that was specifically designed for trading market. We talk more about the cloud breakouts, right, and stuff like that. It's really more on the trading market. So if the market condition changes, traders must avoid the market like I did, right? I avoided the range bound market, right? Or change the trading plan that's being used. So it's always good if you can, you work on one, right? Work on your strength. I think if you take a look at your trading journal, which is really important. The reason why you need to have the trading journal is that you need to have a record. If you are having better times or you're having a great time in the trading market, then that strategy is actually designed more for a trading market. Because if you have a trading journal and when the market shifted from trending market into a range bound market condition and all of a sudden your trades are failing left and right, then you probably have a trading strategy that's actually designed for a trending market. It's not suitable for a sideways market or a range bound market condition. Okay, so I don't know what's good for you because to me the way scalpers in the market is they don't really look at the general underlying trend. They really look at more of the the short-term volatility in the market, right? So it could be that your strategy is designed to be used in the trending market. But anyway, identify which one it is and then work on one, make it good. Okay, it doesn't have to have that 100% probability. You will never achieve 100% probability. With a risk reward ratio of 1 to 2, I only need 40% of the time being right. I only need it to be 40% right all the time, right? So work on this, identify this, and then figure it out. All right. Once you finish one, doesn't have to be perfect, then you can start working on the other one, which is going to be completely different because you will have to have a different mindset when it comes to a trending market or range bound market condition. Because if we are trending, we don't really counter the trend. But when the market is in a sideways market condition, I think some of you guys have shifted this month into more on selling around resistances, buying around support. That really takes a lot, right? It causes a lot of toll on our mental state because it goes against what we usually do. And that's probably why we basically need to have at least two trading strategies to, cover the different market conditions in the market. Okay. Okay, hopefully this answers some of the questions that we have. All right, the last one is going to come back to you, right? It's basically your individual risk profile and your experience. It's not fair comparing my experience to someone that just started, for example, 2 years ago, because we have a gap of about 10 times the years. So every trader will have a different risk profile. I'm more of a defensive guy. I really want to manage my risk a lot more. I'm not really too aggressive on my target levels. If I can achieve my 1 to 2, I'm very happy with it. I don't really go for no. If the market is going to give me 1 to 5, then yeah, I'll take it because I'm a trend following trader. So as long as the trend follows through, then I'm actually going to be fine. But if you ask me to jump into a trade that says, hey, you need to risk double the potential gain, then I obviously look at it and say, hey, that's a no-brainer. I don't think it's worth it because it just bumps up a lot of my potential risk in terms of getting margin called, right? So in general, counter trend traders carry significantly greater risk, and I just mentioned this in terms of looking at the sideways market condition and a trending market. We have two different mentalities. It's actually really hard to shift between the two. So that's why I gave out the option. If you don't have two trading strategies, then you basically need to be able to identify that something has changed in the market, and you basically need to avoid the market for a certain period of time, or maybe look at other asset classes. Okay, so whether or not counter trend trades is suitable must be balanced with trading experience in the market. I think counter trending, the counter trend trading, it's not going to be suitable for, if you don't have a lot of experience in real life trading, then it carries a higher risk, right? So you really need to know what kind of risk it does. Okay, so if you're new, for novice traders, it is recommended not to take a position that is counter trend, number one. Number two, pairs or instruments with low liquidity, such as exotic currencies, and this was brought up yesterday. I think someone was looking at GBP CAD, GBP AUD. I would actually consider that as an exotic. Someone was looking at the South African rand. That's definitely an exotic, right? It's not the major currencies. Um, Focus on four instruments at most. If you're new and you're confused with a lot of the choices, I would focus on four of the more liquid instruments, right? You can choose a major currency, you can use a major index, for example, or major commodities as your choice, and will limit your attention to just about four of them. And the last part is that you do not want to risk more than 10% of your capital. That's actually a logic behind it. That's actually a psychological logic behind it. So, for example, if you start with $100 and you lose $10, right? For you to actually make up that 100 and actually be profitable, you actually need to gain more than that 10% back. Okay. All right. So it is also mandatory to have trading journal to review the trades that have been made, because only through the trading journal that you can actually improve on your own trading plans and your own trading habits. Because if you don't have the help of a trading journal, you wouldn't be able to identify yourself as whether you are a trend trader or a range bound market condition kind of trader, right? Pound cat, is that exotic or is it a cross? It's actually both, right? We call that a cross because it doesn't have the US dollar in it. When we use triangulation, when we compare the pound strength and the Canadian dollars, then we would look at pound cat. But it's not one of the major crosses. The Euro cat is there's probably a lot more volume in Euro cat compared to pound cat. But when we talk about euro pound, that's a different cross, right? It's a cross of a major currencies. But when we talk about the major currencies, the euro and USD and the pound USD has a lot more volume than, let's say, the dollar Canadian. So do we classify that as an exotic? It actually will fall as an exotic. It will also fall as a cross currency as well. Okay, so really simple on this one here. Again, I cannot stress out enough on this one here. Individual risk profile and experience is going to play a huge factor in terms of how you create your own trading strategy. But over time, it should be what I need you to get into. It's more on the comfortable mood that you're actually comfortable with something, you actually trusted something that you personally develop, right? If I were to trade and just ask everyone or different trading communities, hey, what should I do today? Buy, sell, trading signals here and there. I If I were to ask people opinion on a certain thing that's going to impact my wealth, I would need to double check everything. All right, if trader A say, yeah, sell Euro USD, and then trader B is gonna sell, say, buy Euro USD, and me as a trader C, I would look at both recommendations, and then I have my way on looking at the market, and then I'll just compare it. It's really more on benchmarking people's sentiment rather than relying 100% on people that tells you to buy or sell on the market and you don't even know this guy. So I don't trust anyone when it comes to trading. I trust it myself. I would refer to other outlooks. I would refer to what other people are thinking in the market. But at the end of the day, what makes me trade, what affects my trading decision is going to be myself. Okay. So let's talk about confirming with a trading style. Okay, when we talk about your trading plans as well, when do you want to trade? I think that's really critical because if you're trading the pound Canadian dollars during the Asian session, you're not going to do well. If you trade the euro pound before the European session kicks off, obviously you're not going to do well as well. Okay, so yeah, you need to know when do you want to trade, and then figure out once you figure out when you want to trade, you figure out what do you want to trade, right? So when and then what, and then how do you want to trade it, right? Are you going to scalp the market? Are you going to be swing trading? Are you going to be doing an intraday trading? Are you more of a long-term position trading? How do you want to do it? How do you want to actually trade that thing? When you decide when you want to trade, what you want to trade, how do you want to trade, all right? Because by looking at these three things, you would actually identify a certain trading style. I'm not a scalper, and if you're a beginner, I would actually avoid scalping the market because scalping the market requires a lot of it requires you to have a strong mentality in the market. It's going to affect you negatively if you fail scalping the market. Typically, scalping the market carries a risk to reward ratio that's about 1 to 1 or actually 1 to half, right? Because you're not giving a lot of room in the market. You're really trying to bet on a certain volatility in the market. So that's not really me. I'm more of a swing trader. I do day trades, but typically my day trade positions becomes a swing trade because I'm more of a trend following trader, and I would, a trend would develop more than a day typically. So I would stay in that trend for a longer period of time. So I'm more into the swing trading side of things, and sometimes into position trading because I would be able to hold positions in oil, for example. In 2021, we were holding oil for months, right? It was November all the way to about March. Okay, so all these questions that we have on the last slide here, this is actually going to greatly affect how you design and build your own trading strategy. Okay, how about gold? What about gold? Gold, it's a precious metal, it's a commodity, it's a inflationary hedge, it's a safe haven, but not so much of a safe haven as much as the US dollar in 2022. So, taking a look at gold, a lot of new traders just jump into gold, but the mechanics behind gold and understanding what the fundamentals are behind gold is actually going to be different than that behind the currency market. If you look at gold prices, if people are worried about recessions and stuff like that, people are worried about inflation, shouldn't it be higher than what it is? But we're not really looking at that. because people look at the dollar as a much better safe haven because the FOMC continues to hike interest rates. So by holding the US dollar, you're actually going to get a higher return of interest. That's obviously number one. Number two, it's more liquid than gold. Bitcoin and gold. Yeah, so again, right, we are going to be measuring on points, we're going to be measuring on, pips. It's all going to be different. So you need to understand what kind of assets you're going to be looking into. Okay. All right. So any further questions for this session? We did good. We actually did good. We are on time. Okay. So, wow, I still see a lot of people here, even during the last day of trading. And thank you so much for the support. Thank you for joining me on this webinar because, a lot of people are typically going to be away from the market here. Bitcoin, how? We did talk about Bitcoin, so I think cryptocurrencies is a completely different asset as well. Factors behind Nasdaq 100. It's factors behind Nasdaq 100. You would need to be able to understand what the equity mindset is, right? In the equity market and the currency market, it's a completely different market, right? A lot of equity traders actually don't think about short selling the market because it's actually very hard for them to short sell the market in the equity market. So I think it's more on looking at the potential bounces once the market corrects itself. That's one way of looking at the Nasdaq 100, for example, right? We did a discussion on this yesterday, and I say, look, Nasdaq 100, 10,500. That's going to be the key levels when the market opens up in 2023 next week, or 2 weeks from now. If it's if the market reacts to breaking below 10,500, then I think we are going to start the year with more of a negative sentiment in the market. The Nasdaq 100, if you take a look at the movement here, I don't even need to open up the chart because I know this by heart, but right now the market is at about 40% discount, very close to about 50% discount, and we still don't see a strong buying momentum from the market. So I think the way we look at it is that stock traders are still looking at a potential further discounts on this one. That's where we expect a potential for, the correction to go in even lower towards 50% and 61.8%. Okay. What do you think about trading only one pair as a niche? I think it's fine. Seriously, that's how I think that's actually how I actually find my footing. I actually trade the pound USD about maybe 70% of the time. The other currency pair that I trade is the sterling yen. I look at the Euro USD and the Euro Yen as well, but I don't actually trade a lot of Euro USD and a lot of Euro Yen because a lot of the position slots were taken up by the pound USD and the pound yen. I look at dollar yen, but I actually don't trade dollar yen very often. Maybe in a year, I would actually take but less than 10 positions on dollar yen. So yeah, if you want to be niche on it, I think the word niche is actually more. I wouldn't say the word niche. I would actually use the word specialization. It's much better. Um, it's a much better way to say niche, right? So I specializes in using Ichimoku Kinko Hyo. Specializes in a trending market. I specializes in the pound USD and the pound yen. So when the pound USD transition in November, right? Once they sorted out their mini budgets and stuff like that, that's where it was challenging for 2022 because we have a shift in trend. So the market shifted from a downtrend to a potential uptrend that could lead the way into 2023. We just don't know how far it's going to go. But we definitely saw the transition happen in October, November. So that's why I say 2022 was actually a little bit more challenging than what it was in 2021. Do I trade sterling yen or do I trade pound USD? I trade both of them. But the majority of my positions, I look at a lot of currencies, right? I basically look at pretty much nearly everything. Um, but personally, I look at four very specifically: Euro USD, Euro Yen, Pound Yen, Pound USD. But out of the four of them, I think a lot of my trades are actually on the Pound USD. About 70% of the time, it's actually going to be put. In terms of my asset allocation, I think about 70% in the currency market is actually towards Pound USD. Okay. All right. So anything relating to the webinar today, don't ask me to open up my chart because I'm not gonna be, I'm not doing an outlook on this one here. We will do an outlook again in the second week of January. We'll take a week off next week. What is the best time for trading? Really depends. Depends on your location, obviously, and what you want to trade. There's no such thing as the best time to trade. The best time to trade is something that you choose yourself. When do you want to trade? Like for example, if I'm trading the pound USD and the pound yen, just as an example, I would trade the pound yen, very very late Asian session, right? I'll start looking at the sterling yen. I'll start trading the pound USD when the UK market kicks in. But that's my timing in the market. It really depends on what you look at. Is it true that pairs like Euro USD is usually manipulated? I don't think anyone can actually manipulate the currency market. Just to give you an illustration, when the Bank of Japan and the Ministry of Finance intervene on the Japanese yen, right? It causes a little bit of a disruption. It was an intervention, right? Obviously, the goal was basically to strengthen the Japanese yen temporarily and see if the sentiment actually changes. They actually need to do that three times in a period of what, 2 3 weeks, right? So even I look, that takes a lot of toll on them and it costs them a lot just to intervene. I think it's about $13 trillion just to intervene. So I don't think anyone's going to be manipulating the stock market, I'll be honest with you. So, sorry, the currency market. When do you expect resumption of market activities? I would, let me just bring up my calendar. Um, Normal market conditions probably going to resume about the 9th. We should see a little bit of normality on the 9th. Anything beyond the 15th, I think that would be a lot better. Yeah, Daniel, you can watch the Ichimoku webinar again, or we can come back in the session on Wednesday. The session on Wednesday is actually more a Q&A session. It doesn't have to be an Outlook session. So if you have any questions on, Ichimoku, for example, you can come back on Wednesday sessions. Which of the time frame is the best to trade with? Again, comes back to you. What kind of trader are you? If you're a scalper, then you want to be looking at the 5 minutes, 15 minutes time frame. If you're an intraday trader and you only trade during the day, then you don't really want to go higher than the hourly time frame. So again, no best answers to that one. I just explained. I mean, 70% of my asset allocation is actually going towards the pound USD. But yeah, the Euro USD, the Euro Yen, Sterling Yen, and the Pound USD is actually the four favorite currency pairs that I look at because they trend a lot more, and once they trend, there's a lot more volatility behind that, and that suits my trading style. Sure. There's actually two webinars. If you look up Ichimoku Kinko Hill on the OctaFX channel, you should be able to come up with a lot of my webinars. Look for the two most recent one. I think we just did that about a month ago. January normal market when I just say it, after the 9th, we should see a little bit of a normal market condition. CPI, FOMC, and NFP is very high impact news. Why? Because CPI measures the inflation of a country. The FOMC decides what to do with the inflation data, and then tweaks it by hiking or decreasing the interest rate, and then their comments on their economic projections. Is it going to be hawkish? Is it going to be dovish? Right? The NFP It's basically the employment sector, and that's pretty much it. I think the NFE is actually not in focus. If you notice, the past year, the NFE hasn't been the focus. It has been the CPI and what the FOMC does with the inflation numbers. Okay, all right, so we can wrap it up for this year. All right, thanks for joining me on the very last day of trading for 2022. Have a great, fantastic, happy new year. Stay safe, have fun, and I'll see you back here with a weekly outlook next week on the 3rd. And then we resume our normal webinar schedules from the 9th of January onwards. Okay, so have a very happy new year and have a great time. I'll see you soon.